What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, the focus is to update you guys on the double calendar strategy that we have been running around earnings for companies here. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. Make sure that you are subscribed to the channel so you do not miss out on any of these important videos, because believe it or not, this trading strategy so far has produced some very good returns overall here. We're going to break down the numbers. We're going to talk about a couple of trades here, future trades, and some strategy updates that I'm doing to these positions here. First one that I do want to bring up is Intel. We were able to close Intel for a nice and tasty profit. We can pull it up here for you to take a look and see. I did live stream it. I made a video also on the preview of how they're going to do on their earnings here. And what you'll take a look at for earnings is they actually had a big miss on that part. We went over that on the live stream. Take a look at that. You can find it, type in Intel live stream, Fridge Financials. And what you will notice here is that we were able to close the two bought options here. The put became profitable. The call was a loss. And believe it or not, we did lose money here as a result, but we actually made more money on the short options that you will see in the spreadsheet. I'll put the screenshots up as well. And we walked away, I believe, with around $80 in profit. So about an 80% ROI on Intel. Because again, initially it costed us $105 right here. We were able to walk away with $80 in profit. So we made about 80% return on our investment for this double counter, which is an absolutely amazing return in a matter of 2 weeks. So Intel was a great trade that we had that we were able to close out for a nice and tasty profit. Another one that we did close out already before their earnings even happened was Trade Desk. Trade Desk, we did in fact have this contract open up. We bought it for $75 and then we closed it for $82, made about $7 here, which became about a 9% return or so. And you're sitting there saying, well, Fridge, why would you do that for $7 here? It's not the dollar amount, it's the percentage that matters. I was able to open this up on July 25th, close it a week later, and I made 9.3% return on my investment in a week. A 9% return in a week, if I was to keep doing it that way, would be annualized over 400%. So I'm going to be able to take that. And what's going to be happening is as we build the strategy, we fix it, we improve it, we look at different ways to make it more beneficial for everybody. The idea is going to be to scale up. Imagine I did 10 contracts here, $750, we made $70 in a matter of a week. Imagine it was 100 contracts, right? $7,500, we made $700 here. So obviously, as you scale up, you can become and make more money like on the books, but percent-wise, a 9% return is nothing to be ashamed of, and I'm absolutely ecstatic about it. And some of these trades, I have 4 options plays that are for earnings this week. Trade Desk was one of them. If I'm able to close it for 9% profit, and then not have to worry about managing it up to earnings, that just saves me the mental headache and the mental stress of it. Still made good money on it as a percent, but now I only have 3 options that I have to deal with instead of 4. So it's absolutely amazing on that part. And the last trade that we actually closed was Apple. Apple did have earnings, but there was a little bit of a different play that happened here. If you take a look at what we did for Apple here, Apple, what happened was that we were able to close. Let me go back up to the top here because I used to buy into Apple many, many years ago. We opened this position for $96 at the very, very beginning here. We were able to close these 2 positions out for a profit of, I think it was like $110 or so. And I'll show you the spreadsheet that tracks everything. We were able to close these out for about $110 in profit overall. And again, as long as the longs that I had to close out was less than $110 for a loss, I would still make profit as a result. And these 2 right here, actually the puts became profitable before earnings. I closed these at 2 o'clock before their earnings were at 4. The reason why I closed these early, and it's a note that I'm making to myself for this strategy here, is that as you get closer and closer to earnings, what happens is the implied volatility is going to expand. The implied volatility expands because the uncertainty of how the stock's going to move and how the market's going to react becomes more of a risk. When it's more of a risk, people demand more premiums and more pay in order to take on that risk. It's very, very common as to what we talk about with IV and implied volatility. Once earning hits, you get IV crushed because now we know what happened. So now we don't have any unknowns that are happening here. So what I did was I closed these options here at, I believe it was Tuesday, because the IV was starting to pick up Tuesday a little bit more. So I closed these ones out, and then it kept increasing, which made these contracts, even though the stock didn't move much, it still put some more value onto these contracts here. I closed these out, I believe, for it was a $70 loss or something like that. So I actually made $40 on this position, and I didn't even have to play the earnings. Intel was an earnings play. I made $80 there. Apple, I made $40 out of 96 from my initial investment. I made a $4 profit, which is about 47% return, without even letting it go into earnings. So we had basically 3 major plays there. And this is kind of what my 3 levels of the strategy are. Trade desk, we took a 10% profit like a week out. We have 2 weeks for these options. Within the first week, if you make 10%, we close it out, take the 10% profit or 9 or something like that, and move on. Second one is to close the options and then also close the long options before earnings in case that IV expands. And I watched it expand and I closed it out for a profit. And then the third one is obviously to play the earnings and to see how the earnings goes. So some 3 really good plays here that we had that actually worked out very, very nicely for us for profit overall. What you will notice is that I did in fact set limits that are about 10% or so for each of these plays here coming up. So the 3 plays that have options for earnings this week, XYZ after hours on Thursday, Pinterest after hours Thursday, and SoundHound after hours on Thursday. My initial way of managing these 3 here, would be Pinterest is fine. Okay. So if we take a look at Pinterest, what we're looking at here is that the strike prices are $33 and $43 for the calls and the put sides. Right now, Pinterest is trading at $38, literally right in the middle of those 2 strike prices, which means you probably aren't going to get much movement for this week coming up until earnings comes out. So I can let those short legs that I have here, the short legs of this option here, I'm going to let those expire but I'm going to let them decay a little bit more, take some profits, and have those long strangles as a result. So that's kind of what the idea is for Pinterest. I'm happy just leaving it because the strike price, it is sitting right in between my 2 strike prices here, the actual share prices. For XYZ right now, XYZ I'm looking at between 72 and 90 for strikes here, and currently it is trading at 74. So it has come down a lot more to the put side compared to the call side. If I still see a chance to take profit of like 10 or so percent, which I want to get filled here for 10%, it's hard to get filled with multiple legs of options like this here, and especially if you're doing multiple contracts like I have here. If I could be able to close block out for like a 9-10% profit before their earnings, I'm happy with that because the pullback down to the downside has not really been beneficial because the calls become worthless, but then the puts, it becomes a little bit of a risk of that assignment there. It's very similar to what happened with American Express up to earnings, where it ran down and then, I kind of closed it out for a loss here. And what you'll see is that you can see that like it's just had I opened it on the 25th, I think. Let me look and see. 25th, yeah. I opened on the 25th, so right about here. And then ever since then, it's now down like 10%. So, looking at closing block, probably, even if I close it for break even or a small loss, only because it's getting too close to those strike prices, I don't like that. I want to put myself in the best position possible where like Pinterest, if it chills at $38, any expected move to either direction is about the same. So that's going to be great for my positions where it's a little bit harder because say XYZ comes down to my put sides and then it beats on earnings and it beats on guidance and it pumps it up that 5-6%. I'm still nowhere close to being in the money for those call options. So it's still going to get hit with that IV crush, which kind of sucks. So the ideal situation to let it play in earnings would be to have it kind of chill between the two strike prices, because that way that implied move, that expected move, is going to hopefully put either your put side or your call side in the money, which is good profit for you as a result. So XYZ, I would love to close it before earnings unless we get a nice rally tomorrow morning when market opens. Soundhound also kind of similar, 950 and 1450 strikes here. So your middle part would be about $12. And I believe right now it's trading at like 10 something. Yeah, so it's come a decent amount down to the put side. Very similar to XYZ. And we can take a look and see how it's dropped off here. I got in on the 25th, which is like around here somewhere. Yeah, right here at 1171, and now it's down, 14% since. Obviously, it's a volatile stock, so you're expecting those moves, but just that it's come straight down kind of sucks. So we'll have to kind of see what happens here. If I can close Soundhound for a couple dollars profit or for break even, totally cool with it, obviously, because it offsets that risk of being assigned and all that kind of stuff, and the possibility of being IV crushed. So those are my three plays I have here. These are all set up about 10% profit, give or take or so. We're going to go into the table now, look at the data, then talk about the 4 trades we're looking at for the following week. So not this upcoming week, but the next week here. So in table, look at the table. What we have now is all these trades here. The ones that are not grayed out are the ones that are still open. So Block, Pinterest, and Soundhound. As you'll see, we're taking a look at first one is the Intel one. So Intel, we made $155 on the short legs. We lost $70 on the long legs here. The long calls obviously were worth basically nothing. The puts went into the money about $200 or so. So they made profit there. So it offsets that loss. Lost $70 here, made $155. Subtract the two, we get an $85 profit, or about 81% ROI, which is absolutely amazing. Can't complain about it. I'm super, super happy about it as a result. Here's the trade desk trade. Everything closed out all at once here. Again, I made $7 profit here, but again, a 9% return in about a week is absolutely phenomenal by me. I'm totally cool with it. We did the same thing for Amazon and for Reddit and for Moderna. These 3 trades that I did have that was going to go into earnings, Reddit would have printed cash. Let me tell you, because Reddit popped into like 190 something, and my strike price for calls, I remember, was 175. Reddit would have printed me some good money here. But, I took a 10% profit on that one in the first week. No big deal. Same thing with Amazon, took a 10% profit in the first week. Would it have printed? I don't think so. I think it was between 210 and 240, and it was trading at 227, so we got an IV crush there. And then Moderna, even though it was a whopping $6 here, I only put like $30 in for this one, and I made 20% in about a week. And the reason why I closed Moderna out was because it was at risk of a short squeeze. It was being rumored on Reddit forums like Wall Street Bets. I just took the 20% profit and called it a day and just didn't want to touch it. Because if it short squeezes to like $50-$60, that's going to put me in a lot of trouble, which I don't want. So I just want to close it out and call it a day. And again, we have the Block, Pinterest, Soundhound all open right now. Here's the Apple play that we had right here. Apple, we made, again, $110 on the short legs, which is absolutely amazing. The highest percent return on the shorts here at 56%, followed by Charles Schwab at 55%, which is absolutely amazing. I usually look for at least 50% profit because it is a good number to take a look at, take it half off in that case. So that way it kind of offsets that long strangle that you have for price-wise as a result. But was super happy there. As you actually see, the puts went into profit for $10 because not only did Apple come down the day of earnings before it closed, also the IV expanded, which made it be more which may have more of a price to it because of that unexpected volatility that you might have. So this one became profitable. I took a loss here of $79 on the call side because it obviously went down. So we lost $69 on the long calls. We made $110 on the shorts. So we made $41 or about 42.71%. And the numbers at the bottom in the blue are what I want to kind of show you where we're at so far. So we have closed right now, as of recording this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We have 10 data points. There's going to be plenty more. We're going to have 3 more this week. We're going to have 4 more next week. So we have 10 data points at the time of recording this. The more data, the better, as we know. So far, my average, the mean cost to open these trades is about $95, $96 or so. I kind of look forward to be about $100 or so because it's a good, starting off with $100 to trade in and kind of go from there. I also did medians instead of just means and averages because medians are more unlikely to be impacted by those big outliers. Nike is the biggest outlier right now because I made over $1,000 on Nike stock. So I try to take that into account. So people say, well, Fridge, you got lucky with the Hail Mary play here. So I did medians as well because medians are resistant to those big swings, those big values that are profits and losses, right? So it kind of gives a little bit better picture. So the median here was, oh wait, hang on a second, not 105. I got to fix this because, it's actually this one. Never mind. So the median right now for the cost to open was $105, which is pretty good, So about $100 per contract we're looking at here, or per, trade that we're looking at here. And again, we'll grow it as we get more and more confident here. The average profit on the short legs is about $52. The median profit on the short legs is about $76 here. Obviously, this big negative impacting outlier from American Express obviously changes the mean more than the median does, but still a median profit about $76, or, again, the profit overall here that we're looking at is 8.37% profit on the average side and 13% on the median side, or the number in the middle. These numbers right here don't factor in these numbers because I haven't closed anything yet for these ones. So these aren't being factored for. And if you take a look and see up at the top here, it's from this one down to this one, then it skips over to the 14 right down here. So that's kind of what my logic was here. So that way these don't really have any kind of impact. When they close and we can put the data points in, then we're good to go. So those are my numbers right now we're looking at. On the longs here, we're looking at a $102 average return. We're looking at a median return of about $18. Again, a huge difference. That huge $796 outlier from Nike stock obviously pulls the average a lot higher. Similar with American Express one a little bit because we still lost money on this trade here. But, a median return of about $18.50 on the longs here, and a profit about 17% or so as a result. Then we take a look at total profits. The average total profit is $154. Obviously, this number and this number are those big outliers. Delta Airlines and Nike are the big outliers we have here. So the median profit return is about $14 right now. And again, I'm taking small profits here. So what I really care about is the percentages. The average return of these trades right now is 141%. Obviously, Nike had 1,000% return, so that kind of pulls it up a lot more. And even Delta Airlines had a 260% return, so obviously makes a difference. But the median return, which again factors out outliers a little bit, the median return here is 15.29%. And we've been started trading these ones since June 13th. We're going on our second month here, and we're up about 15% in a median return per trade here. We're going to be taking a look at the 4 option plays for this upcoming week. We have 4 major plays for this week coming in. The first one that we have is Applied Materials. Applied Materials, we do have set up with a 195 call option, a 165 put option. We went in with a whopping 1 contract that costed us $103. We opened it up at market close 2 days ago, time of recording this video, and their earnings, I believe, are on Thursday, the 14th after hours, I believe, maybe before hours. I have to double check. So Applied Materials is looking at one that we can potentially make some good money with. When the earnings start to die down, I'll be curious to know how I can keep playing the strategy out here. We'll have to hopefully wait and see. But we did Applied Materials on Thursday. I look for those Thursday, Friday morning pre-market earnings plays here. So Applied Materials looking at $100 here to get in. And then as long as it trades between the 195 to 165, it just kind of sits there for a little while. I am so happy for it until earnings. Looking at the next trade that we have here, we actually have Cisco. Cisco, we went in with a whopping 4 contracts here for $22 each. So it's going to cost us a little less than $100, about $88 here. But the difference is with Cisco earnings is I believe Cisco earnings are actually on a Wednesday. Double check. On a Wednesday. So Wednesday's the 13th. Fridge, you're going against what you're doing. And the reason why I'm doing this is because I want to see what will happen if I play the Wednesday earnings compared to the Thursday earnings, because that's going to just broaden my horizon to even more possibilities for trades here. So they have their earnings after hours Wednesday, because I also was thinking, and I'm pretty sure Delta Airlines, when I traded it, their earnings were Thursday pre-market. So after hours Wednesday, Thursday pre-market, basically the same thing, because I would close them out Thursday market open. So I was like, you know what? Let me try Cisco out and see what happens. Cisco is known to have some good movements here. Very, very well-known company, very, very liquid, which is what we look for. You want these trades to have a lot of liquidity, otherwise the fill rate kind of sucks. So Cisco, we were there for it. We have Applied Materials, we have Cisco, we have new holdings. Why? Well, each contract was like $9. So, why not? Like $9 per contract here. 5 contracts here, $45 here. I believe their earnings are Thursday. Let me just double check because, yep, Thursday after hours, like Applied Materials. So we'll see how this one goes as well. Again, it got filled at I had to go a little bit higher up than I wanted to. So that's why you'll see that this contract is worth a little bit less already. The average right now, or the mid price is about $7. I got it for $9. So obviously, the fill rate makes a huge difference. And then the last one, if you didn't already see, is Rigetti Computing. Expecting a huge move, apparently, and the market, it looks like. Got each of these for $31. Bought 2 of them for $62 overall here. And we're looking for a big move between $12 and $17 for the strikes there. And we shall see how obviously that one goes as a result. The reason why I didn't go 100 every single time, I need to have some cash available to close out the short legs here potentially early, because you got to buy them to close. So I do have some cash sitting here from the profits from last week, just to make sure I can close these ones out in case I need to manage it effectively and everything else. So that is an update on the strategy. So far, 10 trades in, we're looking really good overall. Thank you guys so much for watching. If you made this far in the video, feel free to like the video, subscribe to the channel, turn on those bell notifications for all of these future trades that are going on here. I hope you make money in the market, whether it's through crypto, ETFs, this crazy double calendar strategy, or just from simply buying and holding, stocks that you love. So thank you guys so much for watching today's video. And as always, I will see you in the next video.